Good morning, everyone, or good afternoon. Welcome to the 67th Emerging Growth Conference. I'm Anna Berry. We will be running until about 4 p.m. Eastern today. I want to let you know that our platform works best on Google Chrome, so you might have to refresh if you do experience downtime for more than a minute or two. If you are watching this, you need to watch on Google Chrome. If you're watching from an Apple device, that's what you have to do. Now, all of our conferences are uploaded to the Emerging Growth Conference YouTube channel. Be sure to subscribe at youtube.com/Emerging Growth Conference. During each company's presentation, you can submit questions through our webcast module, and the presenters will attempt to address as many of these at the end of their presentation. One last note, after today's event, you'll be redirected to the registration page for our next conference, so stay on or come back to reserve your spot early. All right, let's begin. We have Lotus Resources Limited. It trades on the ASX under the symbol LOT and on the OTCQB under the symbol LTSRF, and owns an 85% interest in the Kayelekera Uranium Mine located in Malawi, Africa, and has recently acquired a 100% interest in the Keyelekera Uranium Project in Botswana. Lotus's Kayelekera mine in Malawi is a past producer, having produced 11 million pounds uranium between 2009 and 2014, and it's currently on care and maintenance pending a restart. The mine is fully permitted, and Lotus completed a restart definitive feasibility study in 2022. Lotus's Keyelekera project is located in Botswana and has a mineral resource of 190 million pound uranium. Now, Botswana is one of the top mining jurisdictions in the world and the top mining jurisdiction in Africa. We are happy to start off welcoming Keith Bowes, the Managing Director and CEO. Welcome, Keith. How are you doing today?
I'm doing very well, thanks, Anna, and a pleasure to meet you.
We know you're across the world, so we appreciate you staying up late for this conference. The floor is yours. Call me back when you're ready for questions.
Great, thank you very much. And thanks very much to everyone who's joined us today, this morning or this evening, wherever you happen to be. As Anna has mentioned, my name is Keith Bowes, and I'm the Managing Director for Lotus Resources. And as Anna also mentioned, we have two projects. We have our Kayelekera uranium mine, which is located in Malawi, and we have our Keyelekera project, which is located in Botswana. So maybe just to start the presentation off, you can see on my first slide there a nice picture on the right-hand side there. That picture is actually a picture of our Kayelekera uranium mine. This was taken a few years ago, but clearly demonstrates, I think, to everyone that this is a very, very large and very, very well-established mine that is ready to restart on the back of the rising uranium price that we're currently seeing. Just some important notices there with regard to some forward-looking statements that I may be making during the presentation. This, of course, will be available to you to read in more detail, so I'll just quickly glance over it now. I just want to quickly start off with some stuff around the corporate position of Lotus Resources. So Lotus Resources as a company has a market cap today of around $520, $530 million, and that's based on today's closing price of 31 Australian cents per share. We have no debt at this stage. Everything that we've done has been through equity raises. We have, as of the end of the December quarter, something in the order of around $15.9 million. That $15.9 million in the Treasury is sufficient to see us through our initial work programs that I'll be talking about. The company itself is well covered by a number of brokers, including Red Cloud, Shores and Partners, Canaccord, Petra, and BW as well. And just on the left-hand side there, we've just given a small breakdown in terms of the current ownership of the company. There is a very, very large retail base associated with it, predominantly Australia, although we are growing, and hence the reason for having or attending conferences like this, looking at growing our US retail base as well as our investor retail base as well. We have been very, very fortunate as well in having a number of the ETF funds are starting to invest in our company as well, and we've seen a significant growth in them over the last few months. Just talking a little bit about what the company plans on doing. So the company itself is definitely uranium focused. That's what we want to be. We want to be a uranium company that's going to be producing uranium over a number of years. And in order to be able to do that, we obviously have the two projects that I've spoken about, the Kayelekera project, which is a low-cost restart project. I'll talk a little bit about some of the metrics around there, but when I talk about low cost, I'm talking around $88 million of upfront capital is required to be able to restart the Kayelekera asset. At the same time, we have the Letlhakane project, a greenfield project that has got a very, very large resource base behind it, but is certainly the project that we see that can give us the long life that we're looking for. So Lotus is positioning itself as a company that will be able to produce uranium for the next 20 to 25 years. We have a very strong management team in place as well, experience not only in developing projects, experience in uranium, but if you can tell from my accent, also a lot of experience within Africa as well. I've worked in South Africa, I've worked in Zambia, and I've worked in Namibia as well. So a very, very strong team there that can develop these types of projects. And anyone who's been following the uranium price will note that as of the last couple of months or so, we've seen a very, very strong rebound in the spot price. Today's spot price is around $92.50, and we've seen an increase of almost 70 or 80% in that spot price since the beginning of 2023. So a lot of strong fundamentals behind what's driving that spot price, and I'll talk a little bit about those in the next couple of slides. So as mentioned, we've got the two strategic uranium projects. Kayelekera is an existing plant that has all the infrastructure on site and is in a good condition, as you were able to see in that photograph. As Anna mentioned in the introduction, it is a past producing asset. It operated between 2009 and 2014, and in that period produced about 11 million pounds of uranium. All 11 million pounds of that uranium was processed at the Western Conversion Facility, so that it's at Converdyne in the USA, or at Cameco's facility in Canada, or at Orano's facility in France. The project itself has a mining license in place, as well as all of its environmental permits, so a relatively easy project for us to be able to bring back online again. When you start to have a look at the Letlhakane project, different type of project. It's a greenfield project. There's only really been exploration done on that project, but the exploration has shown this very, very large resource that we spoke about. 190 million pounds of uranium in the ground at a grade of around 320 ppm. Now, those people familiar with uranium and maybe looking at projects in Canada and all that will think that's relatively low grade, but that's the sort of average grade for an African project. The projects in Africa are very, very shallow, open cut, and specifically in the case of Letlhakane are actually what we would call free digging. So there's no need to do any drill and blast operations in there. You can literally go in there with an excavation, dig this material up. It's like sand effectively. Dig that up and put it into the processing plant. So mining costs are very, very low. And you can move lots of tons around, of course, based on that. There was a feasibility study done in 2015 by the previous owners that people can reference in terms of getting some idea of the scope of what the project could potentially achieve. Sort of an 18 to 20 year life of mine producing somewhere between 3.5, maybe 4.5 million pounds. But I will emphasize that the way that Lotus is looking at that project is very, very different to the way that the ACAP people looked at that project back in 2015. We're much more focused on high grade cores, looking at ways of being able to get that average grade up so we can feed that into a tank leach process rather than into a heap leach process. I would think that probably a lot of people on this call at the moment are not too familiar with the countries that I've been talking about. So I'll put a couple of slides in here just really to talk about these countries. So Malawi is the one where we have the Kayelekera project. The Malawi itself is located in southern Central Africa. It's bounded by Zambia, Tanzania, Mozambique, and Zimbabwe down to the south. It's unfortunately one of the poorest countries in Africa. It's got a very relatively small population as well, but it is a democratic country. So anyone who's been following some of the issues of uranium supply in countries like Nigeria, where there's been coups d'etats and those types of things, Malawi is one of the countries in the world, in Africa, along with Botswana, that has never had a coup. So it has a very, very strong democratic society associated with it. It is very Western focused in terms of its laws, in terms of the relationships, and in fact it relies from the UK or from the European Union in terms of providing it. Now, being a very, very poor country, it obviously relies on this donor aid to be able to survive, but it has got a plan in place where it's looking to try and develop its economy. And one of the pillars of that development is the mining industry. And hence the reason why we've got the strong support in Malawi from the government for the restart of Kayelekera. So if we look at some of the challenges that we're facing there, obviously foreign exchange is a big issue for the country, trying to bring foreign exchange in there. High inflation rates, unfortunately, occurring at the moment. Lack of development, lack of, in terms of roads and all that kind of stuff, require a bit more work than maybe you would think in a normal first world country. But there's some real opportunities there. As I've mentioned, Malawi is looking to the mining industry to grow its economy. And we also recognize that the strong support from the US, from the UK, from the Union in terms of developing these mines as well. So we are getting a lot of support from those donor groups in terms of moving it forward. Botswana is quite a different country in terms of an African perspective, a lot different to Malawi. It's one of the top mining jurisdictions that we have. So apologies for that, bit of an IT issue there. So as I was saying, Botswana, quite a different country to Malawi, very developed in terms of an African country. And as fact, if you look at the Fraser survey that was done back in 2022, Botswana was actually ranked number 2 in the world. Only Nevada was considered to be a better mining jurisdiction in Botswana in 2022. And the country itself consistently ranks within the top 3 in Africa over the last 5 years or so. Mining is a big industry in Botswana, accounts for about 21% of the GDP. Botswana itself is the highest GDP per capita in Africa, with a mining fiscal regime that is very, very supportive of new developments over there. Challenges that we may look at in terms of Botswana are really the competition between the other mining industries that are going on there. And that's specifically the diamond industry. Botswana has a very, very well-established and developed mining industry, and we will be competing against those high-paying individuals to be able to get a skilled workforce. It's also the first uranium mine in Botswana as well, but there has a lot of work being done by the previous owners in terms of getting the regulations and getting the various standards in place to be able to operate there. So we don't see that as a big issue, but obviously something we do need to work on going forward. I don't want to spend a lot of time on this, but I think it's quite important for the audience to understand exactly what's happening in the uranium space at the moment. So the graphs I've got there on the right-hand side come out of the World Nuclear Association's report that came out in September, October last year. And what the new World Nuclear Association has defined within their reference scenario is that their expectation in terms of the growth of nuclear power generation, their expectation is around an average growth per year of around 3.6%. Now, what does that mean in terms of actual gigawatts produced through the system? So in 2022, the world's nuclear power generation was around 366 gigawatts equivalent of electricity. Assuming their reference case, the WNA is expecting that by 2040, that is going to increase to 686 gigawatts of electricity. Now, as a uranium developer and a uranium producer, we're of course interested in what does that mean from a uranium supply perspective. So you look back in 2022, what was the demand or the reactor requirements to be able to deliver that 366 gigawatts of electricity? About 169 million pounds. Yet primary production from existing mines only accounted for 130 million pounds last year. The remainder of that material came out of inventories, and those are called secondary supplies. We now look forward to 2040. So in order to be able to deliver the 686 gigawatts of electricity, there's something in the order of 335 million pounds of uranium required to be able to deliver that power. Yet the mines that are operating today, when you forecast their production forward, will only be producing 65 million pounds of uranium. There is a lot of new projects that need to come online between now and probably even 2030 to be able to deliver that uranium, to be able to meet the demand of the reactors. And certainly Lotus, with its Kayelekera project and its Letlhakane project, are looking to be able to do that moving forward. So this is exactly what this graph is trying to show at the moment over here. So when we talk about the sizes of the resources, so Kayelekera, as we've mentioned, is our Malawian project, ready to go, had a feasibility study completed in August 2022, low capital of around $88 million required to restart it, 10-year life of mine producing about 20 million pounds during that period at a cost of around $30 per pound. Now, Kayelekera's resources around 51 million pounds. We add in the Letlhakani's resources, we end up with a company that's going to have 241 million pounds of resources. That graph there on the bottom right-hand side effectively shows how we see the two projects working together. The blue bars are the production profile coming out of the DFS that I mentioned for Kayelekera. So that's sort of the 10 years producing 20 million pounds. But that 20 million pounds is quite heavily biased to the first 7 years, where we were producing 2.4, 2.5 million pounds per annum. In the latter part of the schedule, so years 8, 9, and 10, we're actually starting to treat material from the stockpiles. The stockpiles have lower grade and therefore the production drops off. But that's where we see Letlhakani coming in. Letlhakani can come in and fill that gap and potentially could even come in a little bit earlier than that. But that green box that we're showing there is where the Letlhakani potential is. So effectively, as I mentioned in one of the earlier slides, Lotus is presenting itself as a project or as a company that is able to deliver uranium to the uranium market in the order of around 2.5 to maybe 3.5 million pounds per annum for the next 20 to 25 years. Just in terms of a bit of a peer comp against what's happening on the Australian Stock Exchange, who we consider to be our major peers at the moment. So people familiar with uranium companies on the Australian Stock Exchange will recognize the names like Paladin and DPLO, potentially Bannerman and Boss as well. Now, Lotus, with the acquisition of the Letlhakani project, has moved up in terms of the size of its attributable resource. So our attributable resource, because of our 85% ownership only of Kayelekera, is around 234 million pounds. But that makes us the third largest uranium company on the ASX by resource size. And what does that mean when we start to have a look at some of the economics? I'm not too sure how strongly people believe in the concept of dollars per pound in the ground, but it's always a good way to be able to value the projects. So what we've had a look at over here is we've split those projects into two different groups. Mines that are restarting existing assets, such as Boss, Paladin, and Peninsula, and you'll see that their average dollars per pound in the ground is about $8 or just over $8 per pound. If you have a look at companies that are developing greenfield projects, such as DPLO or Bannerman or something like that, you'll see that their average is only $2 per pound. Now, Lotus, prior to the acquisition of Letlhakani, had an average value, in situ value, of around $5.50 per pound. That of course, is reduced with the increase in the size of the resource. We sit at around $2, $2.10 at the moment, which is very, very low compared to our peers if we consider them to be Boss and Paladin. So I do believe there is a significant opportunity for an increase in our share price to be able to get to at least the peer average for companies that are restarting mines. Just some really basic economics for people to get an understanding of where we are at the moment. So assuming a spot price of $91 per pound, which is what it was last week, it's gone up a couple of dollars already this week, but assuming a spot price of $91 per pound and we put our production into the spot market, as I mentioned, we have a cash cost of around $30. An additional $8 is required for our all-in sustaining cost, but that means we have a margin of around $53 per pound. As I mentioned in our production profile, we produce about 2.4, 2.5 million pounds per annum. That means we have an EBITDA of something in the order of $125 million per annum, which means when you look at our upfront capital, we have a payback period of less than 1 year. So some very, very strong economics for Kayelekera moving forward. And of course, if you look at our development strategy, one of the things we will be doing after we've paid back the Kayelekera capital is start to use some of the profits from Kayelekera for the development of the Letlhakani project. I just want to very briefly touch on some next steps. So with regard to Kayelekera, we're looking at the financing options, looking at appointing some debt advisors to help us with that, although we'll also be focused on equity. Moving forward with our offtake, uranium offtake, a lot of North American utilities are very, very interested in signing contracts with us. So we'll be looking at putting some contracts in place over the next couple of months. We're working with the government of Malawi around a mine development agreement, and we're also focused on our operational readiness plan, whether that be a feed program or connections to things like the grids and all that kind of stuff. So a busy few months ahead of us prior to making final investment decision, hopefully by the middle of the year, and then targeting a restart of Kayelekera for late 2025 or early 2026. With regard to Letlhakane, very much focused on some technical issues at the moment in terms of looking at that resource. How can we increase the average grade of it? Try and get that grade up from the current resource grade of 320 ppm to 500 or 600 ppm, which then makes the project a lot more economic and allows us to consider things like tank leaching options for the processing of it. We are looking at things like beneficiation, geometallurgical modeling, the processing options that I've spoken about, infill drill program as well. Currently, the majority of the Letlhakane resource sits in inferred status. There's a significant infill drill program that needs to be done to bring it up to measured and indicated status, which we can then wrap a pre-feasibility study around and be able to put some metrics or some economics around it and be able to present that to the market as well. So Anna, that's the end of the presentation. I'm happy to take any questions if there's anything. Anna?
Gosh, it's just a technological challenge day. All right. Sorry about that. Let's start off with a question from James Gondway. He's a University of Malawi graduate in geology. James says, Mining Review Malawi published an article in 2023 in which the government of Malawi, through the Ministry of Mining, said they will sign the Mining Development Agents Agreement by December of 2023 for the resumption of mining operations. So it's 2024. The MDA is yet to be signed. So what was the holdup for the delay? And can the company and the government reach a compromise with the rise in uranium prices to sign the MDA ASAP?
So we've had a meeting with the government. I was actually in country in Malawi in the middle of December. I had the opportunity to meet with the Minister of Mines and various other parties who are parties to the negotiations of the MDA. And he is correct. There was an announcement made by the minister that she was hopeful we would be able to sign the MDA by the end of December. Unfortunately, with the Christmas period and all that kind of stuff, there's taken a couple of weeks out of the work period, let's say. So we're at the moment are anticipating receiving a final document or a document outlining the government's position in the next few days, which we will then use as the basis for the MDA moving forward. So I'm hopeful that within the next month or two, we'll be able to have an MDA agreement in place. And he's exactly right. With the way the uranium price is going at the moment, it's really, really important we finish this off, this MDA negotiation, as quickly as possible so we can bring the mine back online again, provide the jobs to the Malawians, be able to bring foreign currency in, and be able to service the debt in Malawi at the moment. So very, very focused on getting this done as quickly as possible.
And another question from James. Now, James is from Karanga, the village where the mine is located. And James says, with high unemployment rate, like you just mentioned, many youths, including himself, James, stands to benefit since the mine is located in his home village. Many of them are optimistic to secure the employment with Lotus Resources. And as the company waits for the signing of the MDA, what plans does your company have on the employment? Talk a little bit more about that, if you can.
Yeah, sure. So the MDA is a really important document for us to have in place prior to exercising or starting anything like recruitment or anything like that. We have to make sure we have an MDA in place. Specifically, the MDA will set the fiscal regime that will allow us to go out and get the financing for the project. When we talk to the financiers for this project, they want to see the MDA before they'll provide any funding that will allow us to restart this project back up again. So getting the MDA is the first point, and then talking to the financiers and getting the money is the second part of the process. Once we've achieved that, we can then start talking about how we're going to be doing the recruitment strategy, the timeline associated with the startup of the project. But I can tell James straight away that the focus for the company is to make sure that the people within the area are the ones that are offered the jobs first. That is definitely the focus. And I'm not too sure whether James was around when Kayelekera was operating previously between 2009 and 2014. But I know from the stories or people that I've spoken to and the stories they've told me, the Karonga region was very, very prosperous during that period when the mine was operating. And unfortunately, when the mine shut down, we have seen a drop-off in that in the area. But the expectation is Kayelekera comes back up online, Karonga becomes another prosperous area again.
James also asks, is it better the company starts employing people in different sectors to better equip the workers for the resumption of operations? What are your thoughts on that?
When he's talking about different sectors, I'm assuming he means with different skill sets or different levels of skills. So there's certainly a plan for us to be able to have a training program that will allow us to bring in maybe recent graduates from universities or people who've got some skills that we can then upskill to be able to bring on. One of the important things that happens in Malawi that we're fully supportive of is that although we need to bring in some expatriates to be able to start the mine up, who have the skills in either processing or in mining or in maintenance or whatever it is certainly the intention of the company to be able to get Malawian people employed and get them trained up such that they can replace those expats in the future, and we can reduce the number of expats that we have on site as well. That's certainly the intention that the company has.
Perfect. Frank wants you to clarify about the Kayelekera asset. Did you say you intend to restart this? Why was it shut down in the first place? And what is the time frame to restart?
Okay, so it was shut down in 2014, really on the back of Fukushima. So Fukushima happens in 2011. The uranium price crashes after that. The spot price specifically crashes after that, gets down to levels in sort of the upper 20s or lower 30s at that point in time. Kayelekera, when it was operating, sold the majority of the material into the spot market. Kayelekera's cash costs at that point in time were around $36 per pound. The mine was not making any money. It was actually losing money during that period of time, so it shut down for economic reasons. Now, a lot of the work that we've done, because we acquired the project from Paladin Energy in March of 2020, we've spent a lot of time focused on the project economics to work out how best to get those cash costs down. As I mentioned in my presentation, we believe we can get the cash costs down to $30 per pound. It's on the back of a number of technical pieces of work that we've done and that kind of stuff, but it's also relatively simple things like connecting the plant to the national grid to get cheaper power. That saved us a lot of money by being able to use the grid power rather than diesel gensets. So we've had a big focus on that in terms of making sure that when we start the mine up, we're not going to be in a position where we have to shut down after we've started up because the process is no longer economic. Now, that's on a cost basis, but also from a contracting perspective. As you rightly pointed out, the uranium price is a lot higher today than it was then, so we do think we would be able to be economic starting it up. According to the feasibility study, we require about 15 months to refurbish the plant. So if we make final investment decision by the middle of this year, the intention is we would have the Kayelekera mine up and running by the end of 2025.
Perfect. Rich Perkins says the U.S. has a huge resource of uranium, but is yet to become, it's still a small producer. So his first question is, where are you exporting your uranium? And the second question is, if the U.S. opens up production, what will that do to prices and your margins?
So Kayelekera or Lotus is very much focused on delivering uranium into the North American market. That's where our primary focus has been with the North American utilities, some of the Canadian utilities as well. We've also started to look at some of the European utilities as well as an alternate, let's say. And we've had some discussion with some of the Japanese utilities as well about providing it. We do believe that the majority of our material will go into the United States. Now, when you talk about the volumes, as I think I indicated on that graph on slide 5 or 6, where we're talking about the amount of uranium that is required globally to try and deliver the power or to deliver the power that is forecast in the nuclear reactors going forward, there is a lot of room for a lot of producers to come online to meet that gap. We're talking about a 3.5 million pound per annum production, or maybe 2.5 out of Kayelekera and a bit more when we were operating Letlhakane. there's still probably, something in the order of 100 and something million pounds is required to come online between now and 2030 to be able to deliver it. So even though the US is talking about starting mines back up again, and they will be starting them up and producing, I still believe there's lots and lots of room within the market for a company like Lotus to be able to deliver their product from Kayelekera and from Letlhakane.
Lamar Belavia says, in your opinion, can uranium get back to its 2007 highs? And what global economic events might push it there?
So global highs in 2007 was $137 per pound. Today's price is $92.50. And if you look at any of the forecasters out there, they believe we'll be at over $100 per pound within the next couple of months or so. I certainly think achieving that $137 per pound is achievable, and I think we could see it within the next year or two without any doubt. What are the things that are driving that price? I think it's quite important to note we are talking about the spot market here, and there are two different markets within the uranium space. There's a spot market, which is something that's traded on a short-term maximum delivery period of 12 months. There's also the term market, which has a 5-year, maybe 6 or 7-year contract associated with it. Those two do have different pricing structures associated with them, and at the moment we're seeing the spot price being a lot higher than the term price. What's driving the spot price at the moment is the very, very thin volumes that are available. There is very, very small volumes of uranium being traded in the spot market because the utilities and other companies are pulling material out of that spot market because they need it. So any small change in the availability of uranium in the spot market is having a significant impact in terms of the spot price. And because it's going down, we're seeing the spot price go up. We're seeing a lot of other good pieces of news coming out of the USA. There was a request for proposal that came out 2 days ago for HALEU, which is high assay, low enriched uranium. You've got a couple of acts or legislation sitting in Congress in the US at the moment. One specifically is looking at banning the importation of Russian uranium. That's going to have a big impact if that gets signed through and comes through. The US is going to have to start looking at local production and hopefully looking at other Western companies or countries operating in Western companies that can deliver uranium into that space. So there's a lot of really good momentum behind building that uranium price moving forward.
Absolutely. Douglas Townsend wants to know what, if any, geopolitical issues are you facing in your region?
From a geopolitical perspective, we're actually in a really good position. As I mentioned in the presentation, we're not like Nigeria, which is up in the northern part of Africa where they've had coups and those types of things. Malawi itself is a very democratic country. It's never had a coup previously. We're not seeing a lot of geopolitical issues in that southern part of Africa, and we don't foresee anything moving forward. How the geopolitical issues are impacting us in the moment is more what's happening in places like Ukraine, what's happening between the split between what the Western countries or companies are looking for and what the Eastern companies are looking for. And we're definitely seeing a bifurcation in the market, where you're seeing a lot cheaper purchases or uranium available on the Eastern side compared to what you're seeing in the Western side. So we're not directly impacted by geopolitical, but we're indirectly impacted by it at the moment.
Anthony Fitzgerald wants you to talk a little bit about your inventory.
At the moment, we don't have any uranium inventory. We don't hold any uranium at the moment.
Okay. And Keith, this is fascinating. A great time to be in your industry. Give our viewers some closing remarks, if you don't mind.
Sure. So, as a closing thing, I think, I haven't been in the uranium space that long. When I say I haven't, not that long, it's probably 6 or 7 years. And when I started in the uranium space 6 or 7 years ago, I got told next year is the year that the uranium price is going to increase. And I've been told that every year until last year, when it actually proved to be right. So very, very happy to see where we are at the moment with the uranium price. I think we need these levels of uranium prices to be able to bring new production online. And I'm not just talking about our projects, but I'm talking about the industry in general. I think there's been a recognition from the utilities that if they were to force the the uranium price down to the levels of the 30s and 40s that it was at a year or two ago, there would be no opportunity for any new mines to be able to come online because they're just not economic at that point in time. So the uranium space is really going through a renaissance at the moment in terms of the pricing. But I think what's also important to notice, there's a lot more acceptance from the public around uranium as well. There's been a lot of surveys that have been done recently across Europe, across the USA, in Australia itself as well, and in Asia and all that. And certainly the public perception of uranium and nuclear power has improved considerably over the last couple of years. And there's a lot of support for it because they recognize that it is a safe form of power. It is a relatively cheap form of power as well when you look at the entire life cycle associated with it. And it is a very, very reliable source of power as well. So I'm very, very excited about the uranium space at the moment. And I'm certainly very, very confident that Lotus and its projects will be able to deliver and support that uranium improvement going forward.
Wonderful. Well, great presentation, Keith. Thank you so much for joining us on our conference. We look forward to following you along in this journey. Have a great rest of your day, or for you, have a great night.
Excellent. Thank you very much. And thank you for everyone who's been listening to the presentation.
All right, everyone, stay with us. We'll be back at 11:25 Eastern with Servo Med. We'll be back.